New things. Speaking of people trying out new things, guys, we have to talk about kind of the fintech world, which has seen a lot of money and change in the last couple of years, giving consumers more options with what to do with their money, including things like Robinhood that let people trade for free across crypto, equities, and options. And of course, Chime, which brought kind of a no-fee neobank to the world, into the US market to a big degree. The big news this week is that Robinhood raised more money. And this is the fourth time I've had to say that this year because they've raised 2 mega rounds of 2 tranches apiece. And the news this week is that they added $460 million to their Series G, which was only $200 million before. Maybe that should have been a hint to us that more money was coming. But they're now, their Series G is $660 million at an $11.7 billion post-money valuation. Whew. And that was on top of its preceding quite large, I believe, $600 million Series F from earlier this year. So that's the Robinhood news. Also inside the last week or maybe 8 days, Chime added $485 million at a $14.5 billion valuation, claiming EBITDA profitability. So what we have seen in the last 12 months is Chime and Robinhood raised a combined $2 billion plus. And that seemed to me like a milestone in consumer-facing fintech. And I wanted to just talk about it because the Robinhood effect is real, I think, to some degree, Danny. So when you heard about all this new money for Robinhood, first impressions, what were you thinking?
I mean, I think it's a reminder. I mean, yes, we actually talked about the last round and the lack of dilution at the time, if you remember, on equity. This is not uncommon as you get to later stages where there are investors. It could be pension funds, it could be insurance companies who just need more time to write checks, right? So my guess is they had someone in mind. Total speculation here, but I can imagine there's someone who needs a 6-month lead time to write a multi-$100 million check. And so you write the round, you do a first close with the money from the VCs who are much faster. But then your insurers, your pension funds, and others who need a lot more diligence time, they have to do a lot more work. They're leaving space for them basically on the cap table. So my assumption is it wasn't a sort of random decision. It wasn't like an extension round that came at the last minute. It's actually money that probably was already agreed to months ago with the last round. And look, it's a sign that the company is just doing, adamantly well. It is now broken through much in the way that we were just talking about Zoom. It is broken through into pop culture. It is a more consumer-focused app than Zoom. I mean, who would have thought that an enterprise video conferencing SaaS app would become a verb? Ironically, Robinhood hasn't verbed, right? You don't Robinhood your stocks or something like that. At least I haven't used it as a verb.
You YOLO those call options is what
you Wall Street bet it all the way to the moon. But I think it's also a sign that there's still a lot of potential for Robinhood.
I think there is. And I wonder, sorry, Natasha, please.
I was just going to ask kind of what you guys think is next for Robinhood. I saw in your story, Alex, that Chime is IPO ready kind of within a year's time. But what does Robinhood say about that?
It's a really good question. I think what we have a good idea about with Robinhood is how fast its revenue is scaling. What we don't know is how good of a business it currently is. Like, I don't think we know their gross margins. I don't think we know their kind of current operating margins. There's a lot of questions. So it's very hard to say IPO ready or not. Like with Chime, we know EBITDA profitable. And I clarified with them, it's not adjusted EBITDA positive. It's pure EBITDA positivity, which matters. They're not ripping out share-based comp from that. So we know that Chime is effectively very rich, has about $1 billion in cash, can go public whenever it wants. It's going to wait a year. Fine. Robinhood, more of a question. But if you go back to Q2, their payment for order flow revenue alone was around $180 million, which put them on, Danny, like about $700 million plus.
Is this Robinhood or Chime?
Robinhood, sorry.
Okay.
So Robinhood, we knew that in Q2. They have other incomes as well. So they probably did north of $200 million in revenue in Q2, putting them on an $800 million plus run rate at the point. More capital comes in, they can expand further, things look great. My question is, does the trading boom dissipate at some point? And if so, how much does that hurt them? That's my question. But to me, Robinhood is at least big enough, Natasha, to go public. The question is, are they profitable enough? And I don't know the answer to that.
And then I think on Chime, I mean, one of the dynamics you see in 2020, for all these neobanks is, the incumbents are just getting eviscerated. I mean, you can look at some of the market caps for some of the traditional incumbent banks, but look, the brick and mortar retail bank with thousands of locations in expensive retail corridors in this environment where a lot of folks can't even go outside of their homes is quite possibly the worst business model you could have for a bank today. And so for a Chime to come in, which is app-based, which you can do at home, you can run transactions. Chime's whole model is supposedly feeless, which is debatable, but like that's sort of their models to reduce a lot of the fees for financial services. mostly because they have that efficiency. They don't have the retail banks. A lot of things are automated. And, to me, like a lot of these neobanks are just going to come into their own in the next couple of years. It's not online banking has been a thing for literally 20 years. But nowadays, with the infrastructure in place, there's real scale there. And I think Chime's going to be one of the first out of the gate.
So I wrote a story about this kind of collection of funding rounds and impacts. And I went back through what we kind of know about Chime's revenue growth. And if you go back to stories written in November and December of last year, people were saying 200 million in revenue for the year or 300 million in revenue for the year. Well, Chime told us, to answer your point about the success of this model, that they've grown transaction volume and revenue, top line, by 3x this year. So if it was 200 million last year, it's about 600 million this year. If it was 300 million last year, it's about 900 million this year. Those are legit numbers. That's not just say that's not screwing around. That's rather impressive. So these two companies that have now reached decacorn valuations are not priced at insane revenue multiples like Snowflake was post IPO. They're actually somewhat reasonable. And then the question becomes margins, profitability, and IPO timing. So very exciting stuff. We will see them soon.
And one of the interesting dynamics I learned today, I wrote a funding story, which we're not going to talk about for a lot, about Petal, which is a consumer credit card built around cash flow instead of traditional credit scores. But one of the things that actually came out of that conversation, they raised $57 million from Valar Ventures, their third time that Valar has tripled down the company, was that credit scores have actually increased this year. And the reason is because the government's direct injection of money and funding to individual taxpayers, people paid off their debt. Actually, debt has been massively paid off in the last 6 months. And so for a lot of these banks, if you suddenly get $2,600 in the mail, where do you put it? That's actually been a huge issue for a lot of folks. Banks were closed when those checks were written. And so they had to find ways to create direct deposit accounts. And so it wouldn't surprise me if Chime got a huge boost from the surplus checks. And not only that, like because of the automation, the scale, their expenses did not grow linearly with the transaction volume and the revenue growth. And that's why you're starting to see this EBITDA positive sort of margin there. And that means, as far as I'm concerned, they're ready to go public. Like they're ready to, this could be a SPAC next week. Who knows? There's a lot of fintech SPACs. So, in fact, I think we've talked about it, but, there's at least like 8 or 9 fintech SPACs ready to go. So will not surprise me at all if a company like this is the one to go.
I was just going to add too, like when I compare fintech and edtech's boom, I can't believe I'm saying this, but I feel like I believe more in fintech's boom because unlike edtech, people are definitely expecting a decline there's going to be the decline in users when things reopen. I feel like with banks and with money, it's just so much more sticky that that's not going to happen at the same level. I just see so many edtech companies completely losing people the moment things reopen. They'll keep some of that growth, but something about Robinhood and Chime's growth of new customers during this time feels a little less hard to erase.
I would stack it Chime at the highest because people don't tend to change banks. I did that last year and it was miserable. And then I would say Robinhood number 2, and then I would EdTech in the lower, lower bucket. But with some caveats, like if trading volume drops by half and everyone runs out of money, like Robinhood's hosed. But I mean, probably won't happen, but we'll see. We need to do a